What is up, guys? Welcome back to the channel. My name is John and this is John Paul Investing. So I had a few of you guys comment in the comment sections in my videos about a new stock that could be positioned to potentially short squeeze. The name of the stock is Acquisitive Therapeutics. Acquisitive, I actually have no idea how to pronounce their name correctly, but for the sake of this video, I'm probably just going to stick to Acquisitive. Now, when I mention the short squeeze, this is more of a mechanical thing. I'll tell you right off the bat that this looks like it's going to be more of a short-term play where you buy the rumor and potentially sell the news. So this is something that you'd maybe want to get involved in before the actual news comes out. This is a stock that has been dropping since the beginning of this year. I think even before February it was starting to drop, and at this point the stock is looking pretty good for some upside movement. It actually had a 15% day on Monday. It's actually down 5% today, but this is something that I wanted to bring up, and of course I'm going to bring up some of the macro things that we're seeing in the market right now too, just so you guys have a general scope of how things are looking in the market today and how you can position yourself and your portfolio to capture some of these movements and potentially profit off of them. So don't go anywhere. I'm going to cover all of these things in this video, so stay tuned. Now, I'm also in the process of potentially closing down my Patreon group and starting up a YouTube subscription here. Just that way it's easier to keep everything on one platform. I know the risk of having everything on YouTube and being at the mercy of YouTube, but for the sake of keeping things simple, I'm probably going to move everything here onto YouTube and open up a newsletter of some kind. This newsletter will essentially be anything that I see interesting or of high interest in the market for you guys to potentially take advantage of. You would get in this newsletter. I would more than likely just keep it simple to one post a week, even maybe once every other week, because day to day, not too many things develop. In a special case, maybe I do it day to day, but for the most part, things are really slow in the markets. So I think once a week or even bi-weekly would be the best thing for everyone to get value from without it being too annoying. So if you're interested in that, keep on the lookout for it. Anyone in my Patreon group right now, tell me what you guys would like to see in the Patreon group before I make any of those changes, and I will address them in the Patreon group with you guys directly. Anyways, let's get back to the video. So I did a little bit of digging, and as far as I understand with this company, Acquisitive Therapeutics, they are in the business of advancing medicine, solving therapeutic problems. But what this means is, I believe for the most part, this has to do with how drugs are administered. So one of the main things in their pipeline that is going to be the most soon and upcoming is the, let me pull up the right tab. Their product pipeline includes, at least the most upcoming, is the Libervant TM, which is diazepam. And essentially what this is going to target, the condition that they're targeting, is the breakthrough in seizure and cluster seizure treatments. So to understand this even better as to why they would even address this, I pulled up this article here from frontiersin.org. I've already tried saying this sentence a few times, but I mean, pronouncing some of these molecules, it's really hard to do, so I'm just gonna abbreviate them. Presently, the conventional drugs that are commonly used for the treatment of epilepsy includes this assortment of ingredients and molecules down here. I won't even bother to read them. These drugs also regulate excitatory and inhibitory discharge in the brain and indirectly regulate the excitatory and inhibitory discharge by regulating the ion concentration. However, after treatment, the adverse reactions such as anemia after reproduction and acute cerebellar ataxia may occur. I'm not even sure what that is, but basically they're side effects likely to cause rashes, neurotoxic side effects, blood and respiratory system damage, and other different types of adverse syndromes. In recent years, new drugs have been proposed to treat epilepsy, including these. When compared with the conventional drugs, the advantages of these natural drugs include a broad spectrum of anti-epileptic involving less adverse reactions, higher safety, and lesser drug reactions. So essentially what Acquisitive is doing is they are trying to address this epilepsy market with a treatment that would be very easy to administer orally, and it would hopefully not cause as many, if any at all, adverse effects. Now, what I think the most recent run-up in their stock price has to do with is actually the most recent press release that they released. Acquisitive Therapeutics negotiates a 6-month extension to June 30th of next year for additional Libervant related capital under current debt agreement. This would essentially give them access to $30 million more dollars, contingent that they get FDA approval for the Libervant treatment. And this $30 million is split, $10 million for the FDA approval and $20 million following the FDA grant of U.S. market access for Libervant. So once they actually, start to commercialize it. We continue to believe that our non-invasive and innovative product for refractory epilepsy represents a meaningful improvement in the treatment options available to this patient population and a significant commercial opportunity. So essentially money. We appreciate the continued support from our lenders and their flexibility given the current PDUFA date for Libervant, which 6 months before June 30th would essentially mean, the end of this year. That's as long as they got. This 6-month extension, we maintain the capital optionality and may access up to $30 million additional dollars under our existing debt facility that we can potentially utilize to fund the launch of the Libervant product, said Keith Kendall, CEO of Accusative. The FDA has accepted for filing the resubmission of the new drug application for Libervant. The FDA assigned a PDUFA or Prescription Drug User Fee Act target goal date of December 23rd of this year. They received a complete response letter from the FDA in September of last year, completing a Type A meeting with the FDA in November of last year as well, and received the further guidance from the FDA in February of this year. Based upon their guidance, the submission also included additional statistical modeling and support analysis for the existing clinical data that they have. The company continues to believe that no additional clinical studies will be required for FDA approval of Libervant U.S. market access. So essentially this means they are saying that they don't need to conduct any more studies to prove that this drug works. They're just in the middle of, letting the FDA go over all the data that they've provided to them and to, essentially kind of like Sensonics right now, they're just waiting for, some kind of approval from the FDA. And at that point, they could access this money and then they could start to commercialize probably immediately. So I think that, news, that rumor essentially, because it hasn't quite happened yet, that rumor is essentially pumping Accusative Therapeutics stock quite a bit right now. Just over the last day, they've moved up over 15% and falling around, I would say, at 1.5%. And the market closed with them, down maybe a little bit less than 2% at this point. So other things that I have researched about this stock that we can use to our advantage to analyze whether this is something we'd want to, get involved in is that there's close to 35 million shares outstanding right now in this company. Their short interest right now is close to 2 million shares, and out of 35 million in float, around 40% of that belongs to institutional investors, with 5% belonging to founders and people who are involved in the company. So that leaves around 55% of the float belonging to more than likely retail investors like you and I, and with around 2 million shares in short interest right now. I still don't think that is quite short squeeze territory. I think personally that for us to see some kind of short squeeze, mechanics setting up for the stock, we would have to see something closer to like 40 or 50% of the float tied up in shorts. Right now we're at 2 million as opposed to maybe 5 or 10 million shares that are tied up for short interest. But considering that the stock has been moving down for the past 6 months, the risk to reward ratio for targeting some kind of short squeeze position where you might buy some call options, or you might even just buy the stock outright and not worry about expiration. Right now the risk to reward based upon it just falling for the last 6 months is a lot better than it was earlier this year, for the fact that it's been falling and you can get it cheaper now. Also, this company is not pre-revenue, so they do have existing revenues. The balance sheet is around 50% from their assets to liabilities. I think they're sitting on around 60 million in total assets with around 120 million in liabilities. They are more than well positioned to cover their immediate debts with their current assets versus their current liabilities, so essentially their working capital. They have that capital, and of course, they put up that press release that's going to allow them access to even more capital if they need it. So I don't think they are in a position where they're starving for cash or anything like that. That's not at all where they are, at least based on their financials and this press release. They're not diluting any shareholders to raise this money. They got some debt, and they are willing to sit on that debt for a while and use that to commercialize their product. So with all of that being said, this is a stock that I plan on watching, but I don't plan on touching it at all because, again, I don't feel like it is quite in short squeeze territory. But, you know, like any decision that you make when you invest, you have to have some kind of idea on both sides of the coin, you know, the good and the bad. You know, what are my potential risks? And you have to understand those risks. So simply put, just have an exit strategy already set, whether there's a good outcome or a bad outcome. You just want to have some kind of exit strategy involved, especially it being more of a short-term position, because right now nothing has quite happened yet. Make a decision and stick to it. Now, in other news, as far as the macros go, treasury yields did fall despite Fed taper talk. So we had the FOMC earlier this month, where Jerome Powell mentioned that it is likely they will start to taper bond purchases. They didn't say exactly when. That probably still means the end of next year, honestly. But you know, whenever they mentioned that, you know, the market likes to react, especially in the short-term bond yields. Looking at the 10-year Treasury bond right now, we are at around 1.31%. So if you wanted to make $100,000 a year, you'd have to put up something like $10 million and tied up in bonds. This 10-year Treasury bond is essentially what investors like to look at for risk-free rates. And if you don't know exactly what the risk-free rate of return is, it is essentially the theoretical rate of return on an investment with zero risk. Of course, no investment is without its risks, but in terms of bonds, it's very unlikely that the U.S. government is going to default on your bond if you give them money. In this case, the risk-free rate of return here is around 1.3% over 10 years. So knowing the risk-free rate of return at 1.3%, you have to understand that this does not account for inflation among different types of basket of goods, CPI for one example, and asset inflation as another example. If you account for those things on top of the risk-free rate of return, that gives you the real rate of return. The real rate of return is the actual percentage of return that you would expect on an investment after accounting for these inflation based on, you know, what you're looking at. Now, the real rate of return will be different for different investors based on what you value to have within your portfolio. So let's say CPI is 5%. Your real rate of return would be 1.3% minus your CPI inflation, which would be 5%. So your real rate of return would be around minus 3.7%. If we look at the inflation rate of assets, especially over the last year and a half, 2 years, we're looking at around closer to 10 to 15%. So that means the real rate of return for, you know, desirable assets like real estate and commodities, we're looking at something around, you know, 12 to 13% negative real rates of return. So that means at this point, if you are an investor that is trying to accumulate nothing but bonds, you essentially will be outpaced by inflation in both aspects, really, CPI and asset inflation. You're going to be behind. So what all of this implies that I just brought to you is that investors are looking for places to protect their purchasing power. And right now, U.S. Treasuries are just not that at all. If you leave your money in bonds right now, you will essentially lose purchasing power every single year for the next decade. So what investors are doing to combat this is they are looking for high growth equities. And all equities is just a fancy name for ownership. They are looking for ownership in companies that are expected to outpace this exuberant inflation that we are seeing in the markets. So despite seeing all of this negative movement over the past, 4 or 5 months in the market is still positioned to move higher based upon there being nowhere else to put your money safely to preserve purchasing power. Right now, it just doesn't exist. So if you don't have equities, you're putting your money in commodities, like, there's people buying gold. I prefer Bitcoin. I think that's like, the new gold. That's a whole topic for a different video. People are finding different places to store their wealth because right now they're just looking for a way to make sure that over the next 10 years, they're not, losing money. So just hang in there, guys. You have to be patient. Pick any of the desirable things that you are really knowledgeable in and just accumulate assets, because right now there's nothing better to do than that. Of course, this is not financial advice, but I'm required to say that. Unless I'm like licensed or something, but even some of these guys who are licensed, I feel like don't know this stuff. So if you've been able to hold through this intermittent bear market that we're experiencing right now, just hang in there. I think we're all going to do well. We just have to be a little bit patient. As Warren Buffett has said, it is a tool to transfer wealth from the impatient to the patient. I think that's not verbatim, but it's something close. I really hope you guys enjoyed this video. I will be making another video about my progress in options premiums that I've collected from the beginning of January January up until now. You know, now that we're, you know, a full practically 3 quarters into the year, I want to share with you all the profit I've been able to accumulate from just collecting option premiums. It is a fairly safe way to generate income on your portfolio, and it's something that I think everyone can take advantage of. So if that's something you guys are interested in seeing, I recommend you guys hit that subscribe button so you don't miss out on that video. But anyways, guys, I really hope you enjoyed the video. If you liked this video in particular, go ahead and hit that like button. And again, subscribe to the channel if you want to see more videos in the future. And don't forget to hit the bell notification to get notified when I make videos just like this one. Thank you guys for watching, and I will see you in the next video.